Yo, 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 what is up, guys? Welcome back to another Thompson 2 Cents. I'm Larry Thompson. I'm going to give you my 2 cents on the market. What an August we had. Pretty solid August overall. We'll be going over the charts. As you can see, the theme today will be high flyers beyond tech. I think there's a lot of focus on tech. I think people maybe overweight their thoughts and opinions on tech. And as a technician, that's one of my favorite things to do is to pull back the hood, look at names that no one's paying attention to, that are ripping, that aren't technology, that aren't NVIDIA, Meta, Microsoft, those types of names. It's names that no one's looking at that have even better returns. So that's what we're going to do today, guys. We're going to dive through names outside of tech that look great. But the first thing I want to do, which I want to break down every week, is just start with a zoomed out picture of the market. Because you have to know where we are in the cycle, understanding past cycles, understanding the context of what we're going to talk through today. Because a chart by itself gives you a lot of information, but we want wisdom from the charts, not just information. AI can give you information. We want wisdom. We want to understand the past so we can understand the present and what may happen here as we kind of enter September. So with this chart above, as you guys can see, I try to share this every week because you should be process oriented when you're analyzing the markets. You should focus on boring processes, like looking at similar charts over and over and over again. Kobe put up a lot of jump shots. Boring, but it works. So what you see here, guys, top panel RSI, momentum. Do some research. Look up Wells Wilder, RSI momentum if you're not familiar. Bottom panels, we have breadth, right? The market of stocks, the stocks that make up the S&P 500 and the members above their 200-day. 200-day, just a trending mechanism to understand if stocks are above or below that kind of long-term support. As you can see, RSI is 60, bullish regime, right? S&P members above 50. The majority of stocks are above their long-term trends in uptrends. The thing I want to point out this week is we had a V recovery, right? Faster recovery than we did back here. And what I want to point out about 2020 is September, right? We're about to enter September, which can be a weaker period for the market, right? 4 of the past 5 Septembers, so 80%, right, of the past 5 Septembers have been a down month for the market. And what I wanted to show here to provide context for what I'm about to walk through is understanding that very similar looking setup, right? The market doesn't repeat, it just rhymes. We have similar setups here from the 2020 V bottom to the V bottom we had now. And so kind of see September was kind of a pullback time, but this shakeout, fake out type of mentality, this consolidation was a time to accumulate and not to be fearful as the majority of stocks stayed above their 200-day. So if you're building a framework for investing, because that's what you should do, you should build a framework and a thesis. It's if we do chop sideways, as long as the members above their 200-day stay above 50, we're in a sustained uptrend cycle, and this is just chop and noise. Maybe paired with cyclicality, right? Seasonality in the market. Maybe some of it being the overdoneness of kind of the Fed and some of the moves we've seen in the market to the upside. Some of it's healthy, guys. We've had a strong run off the lows. Some of this can be healthy. So I wanted to bring this chart up. We're entering a period where 4 of the past 5 times the market's been down for the month. I think we end up higher at the end of the year. But this is kind of the context for what I wanted to get into today. All right, so let's take a look at August quickly. If you're looking at the August sector returns, right? So the S&P 500 is made up of 11 sectors. You can just type that into your computer to get familiar with those 11 sectors. But what the S&P 500 doesn't do is those 11 sectors aren't weighted equally. And if you watch my YouTube video from last week, it's a video that you can watch anytime. It's not necessarily relevant to last week. But it talks about the Achilles heel of the S&P 500 specifically. And the Achilles heel is the concentration it has, right? I talked about how the Achilles heel is protected, but if we start to see the Achilles heel being the fact that XLK and mega cap tech makes up a large percentage of it, if we start to see that falter, we start to see rotation within the S&P 500, that could be what causes this choppy period. And what do we see, right? You look at August returns, look at technology. 33% of the S&P 500. Wait, there's 11 sectors, Larry. How does that make up a third of the market? Because that's literally the concentration of it. So as you can see, XLK was the second worst performing. It was only down, right, less than 1%, right? Barely down. But if that continues and you start to continue to see underperformance from technology, that can be where we see the chop. But what we could also see is the majority of sectors up. Fun fact for you, the top 100 stocks in the S&P 100, 500, the top 100 stocks, which are referred to as the S&P 100, make up 70% of the weight in the S&P 500. So in theory, 400 stocks could go up in September, 100 could go down, and the S&P 500 could finish down for the month. So that's why, as I said, as a technician, you get giddy for these moments because you actually we pull back the curtain, look at what's taking place under the hood, and we can trade these things and make money during a period where the market's choppy. So look, healthcare up, materials up, consumer discretionary up, consumer services up, energy up, financials up, real estate up. Okay, a lot of areas of the market are working. We're working in August. And so if we continue to see this rotation, it's early, but if we continue to see this rotation, it's not going to be bullish for the overall market. And so I'm bullish stocks, but maybe not bullish the overall market. Still think we finish the year higher, but this is where you just have to dig back the peel and look within, right? So let's start with the first sector that I think people aren't putting enough focus on, even though it's continuing to crush. Might pull back a little bit here, but you don't hear about it a ton, is financials. So look at the ETF XLF. We'll start here, and then I'll go through a couple individual names. So top panel RSI, as we talked about, right? Momentum. You can see breaking a momentum downtrend to a degree, right? Kind of signaling, okay, a resurgence of that uptrend. You couple that with this actual base breakout to new all-time highs. We have a beautiful setup here, right? Might be a little extended, might see a little bit of a pullback, but overall, you see a beautiful base breakout here, and you could see continued upside in something like this. And if everyone's focused on tech because of interest rate cuts, banks, right? Financials can do really well because if the short end of the curve comes down, that's where the banks borrow, right, against the Fed, and they lend on the longer end, right? That's the spread. If that spread steepens, they collect more net interest margin. You collect more net interest margin. That gives you more ability to do other things, right? Also gives you the ability to invest in AI and maybe lower your workforce overall. So as applications and use cases of AI, maybe financials is one of those areas that see it. People don't switch banks a lot. So as they implement it, people are going to start using it because that's what happens with banks, and people feel safe and secure with banks. So that's kind of the catalyst we could see here. And the bottom panel is the most important panel on this chart because I want to highlight that you'll see the relative strength of financials versus S&P 500. It's been below this 50-day for a while, 50-day SMA of that, right? Just smoothing price trend. And now we're starting to get back above it. If we can see follow through here, maybe we see a little dip, we see follow through above this 50-day, we could continue to see upside in financials. So your homework this weekend is to download XLF, download the components, and look at those individual charts because there's some setups in there that look great. I'll give you two right now. All right, American Express, AXP, right? Great looking chart within, just beautiful setup here. You have this base on base. Some call it a cup and a handle. To me, it's just a base. I don't get caught up in the names. The only reasons the names exist is just to make it easier for people to explain it, right? Like the name in and of itself doesn't signify anything. So it's really just the pattern on the chart that signifies it. The price action and the structure is what signifies it. All right, we're getting overbought. We have this breakout against 325. It's a beautiful looking chart in American Express. American Express, right, tends to have the best loan book because the credit card delinquencies that they deal with are people that tend to have better credit, better net liquidity as a whole. So it tends to be a leader in that space. And if rates kind of stay where they are and they can still collect on that, it's good for them overall. So American Express is one name within XLF that I like. In that space in general, you can look at Visa, you can look at MasterCard. They all kind of look pretty good. You can look at Capital One, similar business model. But look at financials. You don't get a ton of exposure when you're just buying the S&P 500 because, like I said, you get a lot of that tech exposure. It is the second largest holding, but still. Bank of America, just the banks, big banks in general. Like I said, your homework this weekend. Look at Goldman Sachs, look at JP Morgan, look at Citigroup, look at Bank of America, and even zoom out on these charts. Look at monthly charts. I'm showing you the daily to show you the tactical time frame where we could see maybe outperformance in September, while on the surface, the market might not be doing well. Underneath the surface, we see some strength. Look at Bank of America. Once again, this beautiful base breakout pattern. In these moves, right, you might have some backfilling, right? But overall, you might probably want to buy that dip to this zone. And it looks beautiful against 50, right? 50, maybe even 47.50. Bank of America, once again, has that case of the revenue per employee is going to increase with AI. There's a lot of functions within banks that are repetitive. Like it's white collar work that is really grunt work, right? It's white collar grunt work. So businesses that have white collar grunt work are going to see a lot more AI implementation a lot quicker than overly specialized like welding, right? Because it's a lot easier to download a software to read documentations than it is to build and spend CapEx on a robot, because then you have to find someone who can service that newly serviced robot. So something like banks is at the forefront, I think, of the disruption from an employee headcount revenue per employee perspective. So continue to keep an eye on banks here. And like I said, some of those major credit card companies. Next area let's talk about, right? Materials. This is a good looking chart. You're seeing some relative strength in materials. It's early. Like I mentioned, a lot of this rotation is early. If this rotation does occur, we'll see it weeks on, weeks end, right? This is 1 month. 1 month is just the start, but we'll continue to see it. And something like materials is going to let you know pretty soon, because you have this nice base. And like I'm highlighting here with the 200-day, the reason I like to put something like a 200-day on the chart and an all-time high AVWAP is not because those lines signify anything crazy, right? I'm a technician that believes in the quantitative aspect of technical analysis, not the magic aspect of technical analysis. I believe that price structure, right, has meaning. And I believe that the market gives us information that we should try to align with, not fight. And so when you see something like the 200-day, which signifies trend, right? You see the cross below it here, and you see it retested it, got above it, and then we had a quick pivot, right? And now we're back above it. So you can see that the bull started to fight against this downtrend and started to fight against the 200-day. And now that 200-day zone is becoming support when it was resistance. And you're seeing the underlying price action start to favor the upside. And we're above both that all-time high AVWAP and the 200-day SMA. And we're forming this base that if we break out here, right above 92.5, 93, could be off to the races in materials. I'll also tell you something a little unique about some of these smaller sectors of the market is sometimes there's not one name that makes up all the weighting. So a lot of ways you can play these is just by owning the ETF. I don't necessarily think you need to go fishing within the ETFs. This one is made up of Lind as its largest component. LIN makes up 16%. But then you kind of have a little bit more diversification below the surface. But overall, I think even if you just overweight materials, if you see kind of tech underperforming, you could outperform in September while other people are maybe getting chopped up. So materials, another area of the market, kind of pull back the hood, look at some of the individual returns from the past month, because there's some solid names in there. Albemarle, steel looks pretty good. Packaging Corp, Ecolab, kind of pull back the hood here in some of those material names, because you're only getting less than 5% exposure to this when you buy the S&P 500. So every dollar you put into the S&P 500, you're getting less than a nickel of materials exposure. And you're getting 33, maybe 50 cents if you include some other tech areas of tech, which has been great. But if we see some seasonality play out and we see strength under the hood while tech takes a breather, you're going to underperform for the month. All right. Something you don't get a lot of exposure to when it comes to the S&P 500, something that's pretty, right, polarizing in terms of the market. It's battle with Bitcoin, right, shiny rock syndrome, things like that. But for me, it's a chart, right? It has a story in it. It has what investors see and feel about the market. And Right now, we're seeing a all-time high breakout in gold, GLD, right? I'm just looking at an ETF that you guys can purchase, right? This is an investment advice, but it's something that I'm looking at, is gold, right? So GLD, beautiful, right? High and tight bull flag consolidation that's taking place here. And we have this peekaboo, we have this breakout, right? So against 315, gold looks great. How much exposure do you get to gold in the S&P 500? 0% exposure to gold in the S&P 500. There's probably a little bit of exposure, right? But not anything compared to tech. So when you're looking to diversify against the S&P 500, you're looking for things that don't correlate to them, and you're looking for things that protect you against maybe some tech pullback because you're already overexposed to tech in the S&P. Gold is a place to look. So I continue to stay bullish gold. I also give a shout out to some people I work with, right? Jason Purrs, Sam Gatlin run the Gold Rush Live. Give them a follow on Twitter. Follow their show. They've been all over this trade. Metals and mining also look great. Natural gas looks great. And one of the next areas I'm going to talk about also looks good. So like I said, guys, you got to peel back the curtain to see what's taking place. And that's why technicals work so well, because they do that for us if you do the work. Next area of the market, energy, right? Energy, XLE. So energy has a lot of implications. A lot of people like to overthink it because, right, it's the first input. It's kind of the first derivative to a degree into the economy, right? What are energy prices doing? And so there's been a lot made of it in the recent years because of the inflationary surge that we had, and energy really outperformed. And right when it comes to S&P 500, you're not getting a lot of exposure to energy. You're getting barely any exposure to energy, right? Energy makes up less than 3% of the S&P 500. So every dollar you put in, you're getting 3 cents of energy exposure. So look at this. We have a breakout. We have a breakout on our hands, right? Downtrend breakout, right? It hasn't done anything. If you zoom out on this chart, it hasn't done anything. But you have clean risk reward to trade against in something like this. You have this $88 level from that 2024 AVWAP high, right? That's about 88 bucks. So risking $2 to the downside, right? And you have about $10 to the upside, about 100 bucks, right? If we get back to kind of those prior cycle highs, be about 100 bucks. So that's a $10 upside, $2 downside, right? 5-to-1 risk reward ratio in something like energy. I believe that looks great. I think short term, you could potentially see a pullback. We've kind of ran pretty hard, but this $88 level or even this low, so like 87.50, right? I would maybe set that as a low, but I think energy has some legs here. And right, people might get a little nervous, especially money managers, because you got to think about time frames. Money managers, a lot of them that are currently at the top of their game, right, peaking, we'll say they're in their 50s, maybe mid 50s to late 50s to early 60s. They were kind of, right, alive in the 70s. Their parents were alive in the 70s. It probably gave them horror stories of inflation. So they might flock to energy, which they control a lot of the money, right? The older folks control a lot of money, right? They might flock to energy as a safety trade, and you're only getting 3 cents for every dollar you put into the S&P 500. So look at energy charts, break down the charts. I'll give you a couple names here. Oxy looks great. BP looks good. TRP is another name. TAC is another name. So look through those energy charts and find some good risk reward scenarios, because it's an area that even if it outperforms, right, it could go up 20% this month and it wouldn't do anything to the S&P 500. But if you have more exposure than 3%, like an S&P 500, you can get that outperformance in a month like that. So this gets me excited because I think it's a time when if we see some rotation underneath the surface, you can really shine. You can really show the skill set that technicals allows for you to build when it comes to finding relative strength, finding good, clean risk reward scenarios, not getting caught up in the narrative and hype around technology at this moment, understanding the seasonality. And then you create that thesis and framework and you find trades, right? You find the weight of the evidence that can help you kind of execute that. Because on the surface, right, you might just have one chart that aligns with your theory. But when you kind of dig through those charts like we did, you see, oh, September's kind of weak. Oh, we're starting to see a little rotation out of tech. Oh, you know what? These other areas of the market that don't make up a lot of the S&P 500 look good. And from there, right, you can be bullish individual stocks, be bullish energy, financials, materials, gold even, and outperform the market if it struggles for a little bit, or at least lose less money. So that's what I wanted to review. I do want to take some time. I want to give a shout out to some followers who posted about some comments about some chart requests. So I'm going to kind of get through some of those chart requests right now. And then in the comments, leave some chart requests. I see there's a couple people in there. Nicholas Trades, right? Dominic Cartana, Raul. Great to see you guys in the chat. So I will take these chart requests and I'll try to share them every week. So what I'm going to do this week, I think I'm going to actually just break down these charts live with you guys. So I'm going to actually go through those charts live instead of prefabbing the charts. That way you guys kind of see how I look at the market. So Albemarle, right? That's the largest component of lit, which lit looks great, right? Another area you don't get a ton of exposure to in the S&P 500. So let's take a look at ALB. I'll look at it on a couple time frames because he mentions 6-month time frame. So for a 6-month time frame, I would use a weekly chart, right? So right here in stock charts, you go to weekly time period. Right here, we have about 3 years. I'm just going to do a year and a half, right? Just to kind of see, all right, so it's kind of been in a primary, it's kind of been a downtrend. It's starting to reverse. Then I'm going to zoom out real quick, just look at 5 years, kind of see, you can see this chart's reversing. First thing I want to do is see if there's support over here on the chart. Let me remove a couple things I got on here real quick. So the 40-week EMA is a 200-day, right? It's similar to the 200-day. Kind of zoom out and you can see, right, back in 2020, we have similar support levels. So first thing I'll do there is just draw that support line, right? No, like I said with technicals, it gives you great risk management tools, right? It's about managing risk. So kind of see here, 50, right? It's kind of that level. We've ran a lot since then, but that would be the initial level I would kind of see. And then I see another level here around 90. It's not the most significant in the world, but it's just a level I would highlight is around $90. And then what I want to talk about here is this 40-week moving average, right? So 40 weeks is 200 days. You can see the characteristic of price as it's tested it and how it's changing, okay? So let me remove that rectangle. You can see the characteristics. So let me highlight this for us. Okay. So here, right, kind of a choppy sideways price action, and you see the moving average kind of chop sideways, right? And then we break below it. Right? And then we retest, break below, retest, and then we really break below it. And then what happens on that first retest? We fail. Price stays below it, price stays below it. What happens on the second retest? We fail again. Okay, what's happening now? We're actually reversing. We're actually getting and staying above it. That's 3 weeks in a row we stayed above the 200-day. So we're seeing a change in price characteristic. And that is step one in the recognition of long-term trend change, is understanding this trend change in the price dynamic. Okay, so something like Albemarle, I like it here, maybe even against this EMA. So $77 would be that risk level, right? You could even zoom in, I'll zoom in a little bit more, but in general, you can see that price structure and the change in the character of price action that kind of gives you this leg up. So then now, okay, so I think the longer term trend is changing. I like 77 as my risk level. Let's zoom into the daily. Okay, so we zoom into the daily, remove these circles, and you see the price characteristic changing here. And this is where you kind of maybe execute the trade. So zooming in a little bit. All right, so we're kind of working through this level here, building that base breakout, and then probably this 100 areas, maybe where we see some resistance. But overall, I think you could be long here with that $77 level as your stop if you think this trend is going to continue to change and go up, right? Worst case scenario, you get stopped out, 6%, 5-6% lower, right? Maybe it retests and continues to work upwards. But in general, I think Albemarle over that period of time frame could really see a trend change. The other thing I would highlight here is this where like position sizing comes in, right? Trend changes tend to take time. So maybe you start with 25% or even a 50%, you scale into it. And then if it pulls back a little bit, maybe add another 10, 15% as you kind of maybe build a position if you think this overall trend over time is going to change. So great chart, honestly, great looking chart to analyze. And then we'll go to SQM, specialty chemicals, right? Another large component. of lit. All right, seeing the trend change here, and then that 45 level is kind of where you're breaking above. I won't take as much time on this one, but you kind of zoom out and you're seeing that trend change. I mean, I think materials in general kind of look like this. Are we actually going to stick this landing in this trend change? So that's what I'm looking for here in something like this, is actually sticking the landing in this price action. So something like this, it would be that $42 level. It might squint back below here, but above that, right, you kind of have a decent position to kind of see this trend change to continue, right? If it's a bear flag, kind of get out below that $40 level. But good looking charts. Next one I want to go to Sambo 161.8 BVN. Beautiful looking chart. I looked at this one earlier. BVN, what a ripper. Gold mining, right? Getting no exposure in the S&P 500 to this. Beautiful looking chart. Actually, I'll even share this on the monthly because this is something, right? Looking out, you can see the base is kind of breaking out here. Zoom into the weekly. Kind of have this clean level against 1750, long all day above 1750, right? You can see that base in this chart. A space like we just talked about that looks good overall. A space that diversifies you a little bit from the S&P 500. Yeah. Can even do GLD, right? If you want to keep it simple. But in general, gold miners look good. So good looking chart there. Last one we got here is Walmart. Not as impressive of a chart, but that makes sense, right? Consumer staples don't tend to do as well when the market's doing really well, right? Those are defensive areas of the market, right? Overall, Walmart's been a crazy good company over time, but you could see here, let's zoom in, right? You can see in this bottom panel, the underperformance, right? So this is the relative chart, right? Still below this 50-day, just kind of chopping sideways, messy here. I don't see a reason to be long this. I don't see a reason to be in Walmart. If you're, I don't know, if you're looking defensive, maybe. Just in general, this is not a pitch I would swing at right now, something like Walmart. And just to highlight that, right, one of the risk rewards ratios we look at in the market to get the wisdom of the market, because I believe the market does a great job of taking all the intelligent fundamental analysts, macro analysts, technical analysts, taking all the information that they understand, and more importantly, taking the bets they're placing, and it shows up in price to give us the wisdom of the market. So let's just look at one ratio chart, right, to kind of highlight that. Right, I didn't plan on doing this, but just kind of got brought up, so I might as well. So equal weight discretionary, right? So think cars, home builder, or home goods, things that you buy when you have access money, and things you buy no matter what, right? So think about this as top panel, right? Consumer buying things they want. Bottom panel, consumer buying things they need. Middle panel, right? As the ratio goes up, that means consumers, right? That means investors believe consumers are going to have access spending, savings, right? Access savings to spend, discretionary spend to put into the market. And this ratio is right at all-time highs. So overall, there's risk in the market, which is why you see something like staples underperforming. So great insights by you guys. You guys have some good looking charts overall. I do just want to say thanks again for tuning in. I hope you guys can kind of understand the frameworks that I try to build from that top-down perspective because, right, that's the goal. That's the beauty of technical analysis. So I appreciate all the love. Give this video a like, right? Leave a comment for a chart request you guys want me to do next week. I respond to every single comment you guys leave, and I'll go through all the chart requests. You can catch my work. I publish work 5 times a week. I do this show, right? Then Saturday, I write my hostile charts blog on Beehive. And then Sunday, I do my Sunday stock list. That's my favorite. Sunday stock list. If you're not subscribed to that, if you just want to subscribe to one piece of my work, subscribe to the Sunday stock list. You can find it on Twitter. But essentially, I just break down my favorite charts, right? It's just a bunch of charts. It's about 10 to 12 charts every week laid out with what I'm watching in the upcoming week. And then Tuesday, Thursdays, I put out a quick note called Thompson 2 Cents. And then Friday, I go live. So appreciate the love, guys. Let me know in the comments what you guys want me to cover next week. Any chart requests, any sector requests, any individual questions. I'll get those answered. But in the meantime, enjoy Labor Day weekend. College football is back. Go Clemson. Let's beat up on those LSU Tigers tonight. So much love, guys. Peace.